Hello and welcome to the lecture regarding reporting and interpreting bond securities. So we're going to talk a little bit about what bonds are. Most students don't have personal experience with bonds, either as an investor or working for an issuer. So we'll talk about what bonds are, talk about different ways that they can be issued at different values and what the accounting impact is. We'll talk about how to record the early retirement of a bond. That sometimes happens. And then I'll cover two ratios to conclude the chapter. You can tell I'm covering them in a little bit different order because I think this makes more sense. So a corporation, or really any organization, gets its financing, gets its money in order to do things, to grow, from three different sources. One, it could be short-term financing, so 6-month note, 9-month note, something along those lines. That's generally not a good way to finance long-term assets because you get the benefit of the asset over a longer period of time but have to pay it off in a shorter period, so that can cause cash flow problems. The main two ways to get long-term capital would be either through equity, which is selling shares of the company, selling shares of ownership through stock, or long-term debt, borrowing from a bank over a long period of time, or issuing bonds, which we'll talk about. So there are trade-offs between using debt or equity to fund a corporation. So if you use debt, obviously the negative is you have to pay it back. You have to make monthly or annual payments against the debt, and that takes cash away from the business that could be used for other purposes. In addition, debt carries interest with it, so there's an expense associated with debt. The benefit of debt is that they don't have any involvement in your business. They don't tell you what decisions to make, how to price your product, any of those kinds of things. It's a hands-off approach. You don't lose any control. Now with equity, that's where shareholders give you money for shares in the company. Well, the benefit is you get the cash. You don't have to pay it back. Except in the case of cumulative dividends, you don't have to share profits with them legally. So those are the benefits. The downside is those people want to have some involvement in how you're running your company. So you're losing a bit of your control of the company. That's the main downside to that. So bonds are sometimes used for facilities you might be familiar with. This is the Health and Wellness Center at the South Puget Sound Community College. The campus voted, the students voted that they wanted a place where they could work out, a gym so they didn't have to have an outside membership, and they agreed to charge themselves a couple of dollars per credit hour in order to fund that. So in order to finance that, because there's a lot of upfront cost for the building and the equipment and all of that, the college issued a bond. So they borrowed from people so that they could build this building, and the payments are made on that bond from the fees collected by students. So it's kind of a way of getting things done. So a little bit about bond terminology. So the bond indenture is the underlying contract with the bond. And what a bond is really is a way for a company to borrow money directly from the investing public. So if let's say I was Tesla and I was going to build a new factory somewhere and I wanted to raise a lot of money to build that factory. Well, I could go to a bank and borrow that much money. A lot of banks wouldn't want to loan that much money, so that's a problem on big projects. Or if I were Tesla, I could go to the investing market and say, I want to borrow money. This is the interest rate that I'll pay. Are you interested in loaning me this money? And the loan is made to the company through the purchase of a bond. And a bond says you'll get this much interest every period, and then at the end of the life, when the bond matures, you'll get your principal back. So a couple different, the principal is the face amount of the bond. So if it's $1 million, that's the principal of the face amount of the bond, that's the principal. And those are comprised of generally a series of bonds in $1,000 increments, so people can buy a certain amount of it. There are term bonds where they all come due at one point, serial bonds where they come due over a period of dates. Convertible bonds are bonds that have the right associated with them to be converted into common stock at a predetermined rate. Callable bonds allow the company that issues the bonds to redeem them before they mature at usually an agreed upon amount. A contract or coupon rate, that's the interest rate that's shown on the face of the bond, and that's what is the interest that is going to be paid. That rate is different than the market rate or effective rate of interest. That's the rate that investors would expect for a company of that risk profile. So they would compare it to what other companies that are similar are paying in terms of bond rates, and they would expect that same rate. So the face amount, again, I mentioned, is the bonds are selling at the amount to be paid at maturity. So they're not selling above or below that amount. Bonds could be sold at a discount if they sell for less than the face value, and a premium if they sell for more than the face value. So this little diagram, if we start in the middle and work our way out, so if the market rate is equal to contract rate, so we're in a company, we're going to issue bonds, we're going to want to try to make our best estimate as to what interest rate investors expect. And if we guess exactly right, then every investor is going to be willing to give us $1,000 for a $1,000 bond, assuming that rate of interest meets their expectations. So let's go to the left. If the market rate is greater than the contract rate, let's say I issue my bonds at 4% and investors really were expecting 5% because that's what other similar companies are offering, well, then they're not going to be willing to pay $1,000 for that. So they're going to pay something less, $950 or something like that. And so the total amount that we receive when we issue the bond will be less than the amount that we owe when the bond matures. So we've issued it at a discount. If we go to the right of the middle, if the market rate is less than the contract rate, say I issue my bonds at 6% when the market expects 5%, then people are going to give me more than $1,000. I'm going to issue it at a premium because there'll be competition to invest in those bonds. So I'll issue it at a premium and I'll receive more cash than what I'm going to have to pay back when the bond matures. So a cash payment calculation, if we have a $1,000 face value, an individual bond, the term is 10 years, the rate is 6%, and if the interest is paid semi-annually, which is very common, then the amount of interest that's paid is going to be the face value of the bond times the interest rate times 1/2. So in this case, it would be $30 would be paid. So the cash paid for the bond is equal to the present value, which we talked about in the last lecture, of the future cash flows based on the rate that they expect to receive. So they would look at the annuity of those interest payments plus the lump sum of the bond face value repayment and say, what would I pay based on that present value? That's how investors would make that judgment as to whether it's a good deal or not. So the accounting for bonds that are sold at face value, a company receives cash, we debit cash, we credit bonds payable for the face amount. Each time that we pay interest, we debit interest expense and credit cash. We do that every single year, and then when the bonds mature at the end of their life, we pay out the cash, so we debit bonds payable to wipe it off the books and credit cash. Now when bonds are sold at a discount, we'll have that difference between the amount that we received and the amount that we owe. So when we make an entry, say we owe $1 million for the face value of the bonds and we receive $950,000, we're going to debit cash for $950,000, credit bond payable for $1 million that we owe, so we need another debit. That debit is going to be discount on bonds payable. It's a contra liability account. So when we issue the bond, we're going to have a debit balance in discount on bonds payable. We need to spread that over the life of the bond, so we amortize it as we make interest payments. So this example here is a straight line amortization of it. So we split it into equal chunks, and each time we pay out interest, that's the credit to cash. That's based on the face of the bond, the interest rate and the face value. And we take one chunk. In this case, it's 1/10 of the bond discount. This must have been a 10-year bond. So I take 1/10 of it, and that causes their interest expense to be higher. So we calculate the interest expense, the debit, based on the sum of the two credits. So that's how when we issue at a discount, our expense is going to be higher than what we pay. Now, the opposite is true when there's a premium. So if we receive more cash than what we owe, we're going to need another credit to balance that entry at issuance. So we've got this account premium on bonds payable. Because it has a credit balance, we need to amortize it down with debits. So here I'm paying out the $6,000. I'm debiting, lowering the premium on bonds payable based on the amortization. That causes me to have a lower interest expense than the cash I pay. So there is also an effective interest model where we take the book value, meaning the face value of the bond minus the unamortized discount or plus the unamortized premium, and we multiply it by the market interest rate. So we'll have to figure out what that market interest rate was. So we'll compute that, we'll take the difference between the cash that's owed, and then we'll compute an amortization account, and it'll affect interest expense. So it's a different method that takes more of it up front, less of it over time. So when bonds are redeemed, that's when companies say, we want to buy these back, and they maybe negotiate that with the individual investors about what they would take to retire them early. In that case, they would recognize a gain or a loss if that happened. So they would do an entry where they would recognize the cash they pay out to retire the bond. They would take the old bond and the premium or discount off the books, and that would result then in a gain or loss on redemption of bonds. So here's an example of paying out cash to redeem a bond payable. In this case, on the top one, we have a $2,000 gain. On the bottom one, we have a $1,500 loss. I mentioned there are a couple of ratios that are relevant in this case here. The first is times interest earned. We basically take the net income and we add interest expense and income tax expense, and we divide that by interest expense. That tells us how many multiples their earnings are of what their annual interest expense is. So you can imagine bondholders that are looking to the company's earnings to pay them the interest on their bonds, which could be significant, want to know how much cushion is there. They want to make sure the company is earning plenty of money to be able to pay their interest. So this is a ratio to determine that. The other ratio that's a really interesting one that you'll probably hear a lot about is the debt to equity ratio. This looks at the company's ability to weather financial storms that are coming. It looks at how much they have financed the company with debt versus equity from the ownership. So companies that have a high debt to equity ratio, they have a lot of debt relative to what the owners have invested in the company. And if there's an economic downturn, it can hurt them badly because they are having to make debt payments in spite of having poor results and maybe a lack of profits. So companies with higher debt to equity ratios are generally in a riskier position than companies with a lower debt to equity ratio. So that's the end of the lecture for Chapter 10, and I look forward to talking to you in the lecture for Chapter 11. Thank you.